Hello, everyone. Welcome to the key levels and market structure video lesson. If you are just watching this on YouTube, make sure to head over to nobeltrading.com and take the free course and learn how to trade. So, market structures, the important thing here is to never overcomplicate anything. All right. It can be very simple. So, if we go to a 65-minute chart, is this bullish or bearish? It's bearish. We can simply look at lower highs and lower lows, and there's your trend. It doesn't need to be any more complex than that. We can also do simple things like drawing a trend line here and looking to see if we can get multiple touches. So it looks like actually best trend line is from here. Okay. So if we can get over this trend line and we can see something that maybe starts to set higher highs and higher lows, that's a flip. And already in this turn, you're starting to see the beginning of that flip, right? We're starting to see higher lows and higher highs, slightly higher highs start to form. And then we could use this trend line to say, okay, there's been a flip in structure, right? We don't need to use EMAs or anything. That's just simple price action. Of course, you can go to the daily. You can draw out, some daily moving averages. Well, not draw them out. Just apply them to your chart. On TradingView, any major brokerage is going to have something like a 50, 100-day, 200-day moving average. You're trading above them bullish. You're trading below them bearish, right? But in this part of the course, we're just going over the bare bone basics. Bare bone basics are higher highs, bullish. Lower highs, bearish, right? And it sounds overly simplistic, but many traders will fight it. And you never want to get in front of a trend. That's a good way to get ran over, okay? The trend needs to be invalidated, or you need to have very solid reasoning why it will be invalidated to get in front of that, okay? And even if you think it will get invalidated, oftentimes it's best to just wait for the break. So, next part of this is key levels. So, the key levels, there's the three things we want in the course, right? Number of touches, magnitude of the move after the touch, and then we want we want clarity across time frames. Okay, so when you're going through a chart and you're kind of marking out some key levels, depending on what you're looking at, like right now we're looking at Solana, so there's no real need for us to go higher than a daily. We're looking at this one because a member requested that I mark up a Solana chart, so that's why we're going to kind of dive into this. So already here, it looks like we've got some solid key levels here. As we can see, this is a major low. And then we have some where this became a key pivot point, became a resistance, then became a major breakout level. Again, some consolidation at this level, became a major low here, became a major low here as well. Looks like this recent low can also be set because it looks like this is an area of chop, right? Area chop right here, where this became major support, the upper band became major resistance, then also became support. So those are two really easy levels. And the noise, this is a major low, major high. We can go ahead and just set those. That's a multi-year low right there, so it automatically can be set. Looks like this is a low as well. Now you can see that across these lows, and in fact, we might put that there. Now these sections right here, where you get below this line, are not key levels. First of all, they're just wicks. These are all fake outs. So if I was trading this, let's say I'm long, these wouldn't even stop me out of a trade because there's no continuation. So if I'm in a swing here and I see this gap down, I'll need to give it a day to see if it's going to actually break the level. A touch of a level is not a break. The market needs to give you confirmation. You got to remember, a lot of this not a science, more of an art. Key levels are need to be given room to breathe. Okay, and that's why many traders struggle when they're new and they're starting hard stops. Market doesn't really care about your stops. Oftentimes those stops become a liquidity grab, or the market will come, find the buyers down below that, and then shoot back up. So you have to give them room to breathe. You have to get that second candle confirmation for that key level. So I don't worry about stuff like that. That does not invalidate the key level here. It looks like this one. There's another one down here. Previous high that then became a low. Also a major low from here on a longer time frame. Let's kind of scope out back in again. Let's try to set some more right here. Looks like that is. You got some wicks below here, but they didn't get a good magnitude of the move. This one's got a few, but not a good magnitude of the move. These look like failed breakouts over that key level. There's probably one here. Again, that one doesn't matter. It looks like a failed breakout, but this became major support here. Major resistance with some failed breakouts as well. Let's see. Looks like we got another one there as well. Major resistance. Became an area of support as well with some failed breakdowns. And then from here, there's probably another one in here. Not enough clarity. Maybe if we zoom out. No, not quite. That looks like a major double top to be aware of. And kind of in this range, it looks like a lot of noise. So I'm not going to mark that up. So this would be a point where you could go to a smaller time frame, 60-minute or the 65-minute. We like to use the 65-minute. And we can kind of go back into this chop range and then see, okay, do these levels, right? These all look like failed breakouts. And then we can kind of see down here below. Okay, so here's your clarity on the smaller time frame. And we've also got some really good clarity here on the smaller time frame as well. And the short-term price action, shorter-term price action, you've got some clarity here. Looks like this is your major level to hold to catch for this to climb higher. And it looks like you might find some resistance here. This was prior resistance, multiple touches there, so they might be finding resistance. So in the shorter time frame, that's what you might want to watch. Let's go back out to the daily and see if we can find a trend line. Excuse me. It looks like we've got a very steep trend line here. This bearish trend, right? Hopefully everyone sees this bearish structure here, right? It's a lot of noise, but we can kind of see we're setting higher lows, right? And, or I'm sorry, lower highs and lower lows. So really you want to break this key level. And this is where I'd even step in and maybe even set an alert. And that's where I would take my trade to get long if I was going to take a short based off these key levels. I'd be willing to test it at this key level with a tight stop to this 164 range, and then add if we break 147. Very simple, just using the key levels, nothing else, following the trend. If the trend fails here, you know, another entry honestly from here is if you fail this breakout, this 173, if this prior support turns into resistance, that could be a good short as well. In fact, this key level looks like there's another one here that would probably be more paired on a shorter time frame, but it's not very strong here with just like 3 wicks to it. But yeah, that's the process. Starting from the high time frame, understanding the basics. Where's the market headed? Is it bullish or is it bearish here? Okay, and also going through the longer time frames. This is bearish from the daily. If we go to the weekly, it's kind of neutral in consolidation, right? It's not going anywhere. It's actually trading in a a massive 200% range, right? So, if you wanted to be net bearish on this, you probably want to break this major range. And if you want to be bullish, you probably, if you wanted to say that the weekly is bullish, you probably want to break this upper band at 260. But right now, that's a lot of noise. Then zoom in, we set the key levels there, and that's how you handle that on the short-term price action. It's very simple, and many people will try to overcomplicate this. Lots of fundamental guys won't like this, what we did here. They'll say this doesn't work, but the thing here is price has a memory. People remember how things traded at certain prices, and then that changes how they changes their behavior. Okay, a setup like this, think about it psychologically. A setup of this almost looks like a giant cup and handle, right? You got this big trough, and then it kind of dips. So people get excited here. They get excited here because they're like, "Wow, it's been years, and now we're back at new highs." They get that euphoric, and then it falls through, and it falls through like this, and it just falls off people's radar. At that point, people aren't watching it. Well, then when the price sneaks up, and it's back to 260, that kind of sneaks up on people, right? They waited forever. They finally got the breakout. The breakout failed, and then it just falls off the radar. And it comes back, and everyone almost into it at the new highs, right? It's one of my favorite psychological setups. Simple cup and handle. The simplicity works. So even though we're not explaining all that psychology when we talk about this key level is important, this trend line's important, we don't really need to. You don't really need to understand all of that, or what's happening with the buyers and sellers, or the bid or ask, or the fundamentals, because the objective with true mastery is taking things that are very complex to the simplest form possible, and for your parameters of your trade to be as simple as possible, so you have as few distractions as possible, so that you can act with more confidence and clarity in your trades. It's already hard enough as is. Do not go creating some super complex strategy and making what's already extremely difficult even harder. Okay? Hope you found that helpful. God bless. Good luck on your course.